diversification has been misunderstood for a long time. When you ask anyone what is diversification, you'll get completely different answers from different people, right? How can something like diversification be so complicated? To simplify that, we came up with diversification score. First of all, let's get the diversification. What is the definition of diversification straight? A diversifying product, a diversifying fund, or a diversifying asset class is something that helps you protect you during crisis, be it financial crisis, be it COVID, be it the Lehman bankruptcy, be it the tech crisis, right? It helps you protect during crisis. It helps the downside, it helps in downside protection, right? Diversification doesn't mean that no, you have a large cap fund and you buy a small cap fund. That is not diversification. Both funds, doesn't matter what kind of market cap, doesn't matter what kind of sector or factor it is, they all come under equity risk. So diversifying asset is something that helps you during a crisis period. But how do you measure it, right? Like, it's very difficult to understand. How do I know this fund or this product is good for me and I can finally say that this is a diversifying asset? This is why we introduced diversification score, and I'll also explain how we calculate this, right? So basically the score is from 0 to 100. From the chart you can see that 0 is the worst, the least diversifying. There's no diversification benefits at all, right? This is basically all the equity products come nearby 0, right? So any equity, be it quant small cap or large cap or any thematic ETFs, right? These all come under low diversifying products. So I've taken the gold asset class specifically to showcase the diversification benefits of gold here, right? So gold has a diversification score of 60 out of 100, 100 being the best. And how do you measure this, right? So the measurement of diversification score comes from this number called downside beta to Nifty 50 index, basically downside beta to the equity markets, right? So when equity markets are going down, you cannot have a very high beta, right? Like if you have a beta of 1 when equity markets are going down, then that means that this product is also going down, right? Because the sensitivity to the market is exactly the same. So there's no diversification benefits, right? When equity markets are going down, you need a product that helps you diversify. And the score exactly tells you that without getting into any of the metrics, right? There's so many metrics that you can look into in terms of diversification, right? Just by looking at the score, just one score, nothing complicated, just one score, you can completely understand whether your portfolio or whether this fund has diversification benefits or not, period, right? No one can escape from the score, right? If it has a low score, that means that it has a high beta to the high downside beta to the stock market, and that's what this score tells you. So downside beta we have already understood, right? Now that we have understood, you also want to quickly understand whether this diversifying product, how can it improve my return or risk, right? And this is where the next two charts come into picture, right? We show you the diversification benefits of adding this asset class or adding this fund into a Nifty 50. Basically, we assume an equity portfolio of Nifty 50, right? So Nifty 50 is here, which is the blue, which is the yellow line, and orange is after adding this to your allocation, right? So you reduce the allocation of your equity from 100% to 75%. And add this diversifying product, right? 25%, again like an assumption, right? The incredible thing here is that the return goes up slightly, so you're not compromising on the returns, right? Basically you're actually getting more CAGR by adding gold, but you're getting 12% reduction in just by adding 25% gold to your portfolio. You get 12% reduction in maximum drawdown, that is the maximum loss that you can lose. But the most important thing is this chart, right? a Sharpe of 0.86, like you're increasing your Sharpe from 0.6 to 0.86. That is a massive improvement in terms of Sharpe ratio, right? So this helps you just by understanding these four charts. You know the diversification benefits of gold or silver or any commodities or any diversifying assets in the world within just four charts. And there you go. Like there cannot be any more confusion on diversification anymore, right? We curated this tab to understand the diversification benefits of any asset class, any mutual funds or ETFs out there. Each and every tab in Phenomenal is curated for a reason, right? It tells you a story about the fund. At the end of the last tab, you can write a story, you can write a movie about this fund, and that's what Phenomenal is all about, right? We are not like any other analytics platforms out there that just throws you numbers and charts and place charts and random numbers here and there, right? These things are curated for a reason. That's the main reason we start with benchmark is that our core philosophy itself is where like the benchmark is like we have made sure our core philosophy, whatever Phenomenal stands for, we've also inculcated that into our software, and that's why we believe that benchmark is the most important thing, and that's why we always start off with the benchmark. And that's also one of the reasons why you always see in any tab you go, benchmark is the first thing you see. At the top, you can see the suggested benchmark, and you also compare this portfolio with the benchmark. Thanks a lot for watching, and if you have any questions about the diversification benefits or about this diversification analytics, right, I would be happy to discuss with you all. Thank you.